Welcome back. Mark Fidgett here with notapennydown.com. Today I want to talk about a subject that I'm passionate about and one that I've been receiving a lot of questions, and that's second mortgage investing. How does it work? How secure is it? What type of return do I get? Lots of questions. So I'm gonna start with the basics. I'm gonna try to keep it as short as I can, but bear in mind there's a lot of information about second mortgage investing, and I love this type of investing. So let's talk about what three things need to be present for second mortgage investing to take place. You really need three things. You need an asset, number one. Now, the asset, as far as what type of lending I do, is prime residential real estate located in the Lower Mainland. So that's a single family home, a townhome, maybe a condo. The second thing you need is a lender, and we'll call that cash. Now, the lender and the cash, let's talk about that for a minute. There's two forms. Number one is, the first one is you've got cash sitting in the bank. And as you and I both know, the type of returns that you get in the bank are pretty poor. So that's number one. That's the first type of cash that we have. Number two is equity. And equity is the amount of money that you have sitting in your home. So let's say your home is worth $600,000 and you've got a first mortgage for, say, $200,000. You've got $400,000 in equity built up in your home that's doing nothing. So there's two trains of thought there. Number one is, it's in my house, it's safe, it's maybe not getting me any money, but it's not at risk. Number two is, I've got all this equity built up in my house, but it's not doing anything for me. I got $400,000 of my hard-earned money sitting in my home, but it's not making me any money. So those are the two types of cash scenarios that we have in terms of money. The third thing that we need to make up a second mortgage is a borrower. Now, second mortgage investing is a tricky investing, and I always, whenever I get involved in any type of investing, and whenever I suggest this or any type of investing to anybody, I tell them one thing: make sure you know what the worst case scenario is, because I always like to look at the worst case scenario, because you never know. Now obviously I do my best to avoid that worst case scenario, but I want you to know what it is. So let's talk about the worst case scenario. Let's say we find an asset, and the asset is worth $600,000, and that belongs to our borrower. So we now have two of the requirements for second mortgage lending. We have a guy who's got a home that's worth $600,000. Let's say he's got a first mortgage with one of the banks for $200,000. So if you take the $200 that he owes off of the $600, he's got $400,000 in equity built up in his home. But for some reason he needs more money and he can't get it. So let's talk about that for 1 minute. There's two types of lending. Well, more than two, but let's talk about one type of lending. There's lenders out there, and you've probably heard them advertise on the radio and TV, where they say credit's no problem, job no problem. You don't have a job, you don't have a credit, we don't care as long as you've got equity. That's not the type of lending that I do, although people do it. The type of lending I do is I want a prime piece of real estate. So number one is, when I say prime, first of all, I send my appraiser in. No other appraiser goes in. My appraiser goes in representing me. So I make sure that when I get the value of this property, it's true blue value that I know, as opposed to some appraiser sending me value and I'm taking their word for it and I don't know who they are. Number two is, I look very closely at the borrower. So this is a big part of my underwriting job, my job for you. Because before I come to you, I look at this borrower. I check their credit, I check their income, I check a whole slew of things, because I want to know, number one is, how's their credit? Because generally the way the credit works is they're going to continue doing what they've been doing. So if they haven't been paying their bills, chances are they're still not going to pay their bills. So I don't want to lend the money, especially when it's your money. Number two is, what's their income like? What's the possibility that they're going to be able to make the payments on their second mortgage? Is it good? What's the exit strategy? Do they live in the home? And that's a big thing for me, because I only want to lend on properties that are owner occupied, because experience shows that people that live in homes that they own take better care of them than renters. So let's look back at this guy. He's got 400 grand, he wants 100,000. So I would potentially say to him, okay, listen, I'm going to look at your first I'm going to look at your credit and your income, and your ability to pay, your exit strategy. I'm going to look at all of those when I underwrite the file. Then I'm going to make sure that the property is worth what he says it's worth. Once I confirm that, and I confirm what he owes, and I confirm everything, I make him an offer. I say, okay, I can get you this $100,000, but you're going to pay 14% interest only for 1 year. And I only do 1 year terms, mostly. I can't say only, but mostly I do 1 year terms. They're quick. Market, you know what the market's basically going to do in a year, as opposed to taking a 5 year term where maybe 5 years down the road the market craps out, who knows. So it's a 1 year term at 14%. If he likes it and he agrees to it, I then come to potentially you. And I say, listen, here's what I've got. I've got Mr. Smith. He owns a home worth $600,000. He owes the Royal Bank $200,000. Here's his credit. Here's what his income's like. Here's his exit strategy. Here's why I think this deal is good. And at that point, you say to me, Mark, I like it. Let's do it. So then we send him a commitment letter. He signs it. And then at that point, it now becomes a regular mortgage. You've probably gone through this process. We send our documents to our lawyer. I'm saying our lawyer. My lawyer handles everything. It's not another lawyer. It's not another appraiser. We control the whole transaction from start to finish. So we send our commitment to the lawyer. The lawyer gets the client in. They sign. They register the security. So let's talk about the security for a minute. Because lots of people say, well, how secure is my money? Well, like we said, the property's worth $600,000 today. He owes $200,000 today. So he's got $400,000 equity today. And when I say today, because we have to fast forward a year from now. If by chance he can't pay that $100,000, he's got $300,000 in equity. So what's the worst case scenario? Now this doesn't happen if you do this underwriting correctly. But let's look at that worst case scenario. In BC, if they don't make their payments, you can foreclose. Now the foreclosure process can take from 6 months to a year. But here's what you're looking at. You're looking at $300,000 in equity. So at the end of the year, if he hasn't paid you, now let's face it, if this guy's smart, he's going to pay you before any types of foreclosure takes place, because he's got $300,000 of hard-earned equity in his home. The last thing he wants is for us to come in there and take it. But we do have that ability once time is on our side. So if he is a type of person who ignores all our letters, ignores the lawyer's warnings, and he basically doesn't respond, at the end of the day, 6 months to a year, you go in there, we take possession of the home, we sell it, we pay off the $200,000 to the bank, we pay off the legal fees, we pay off the realtor. Out of this $300,000, we pay off the money he owes us, any interest and principal owing, and all legal fees. So we get all our money back if the research has been done right. So for me, I love this investing because, as you probably know, the more interest that you make, generally the higher the risk. So there are higher interest rates in terms of investments, but the risk is higher. For this, the risk is secured by property in the Lower Mainland. So could the market crap out in a year and go down 50%? Well, I guess it could. So then you'd have a $600,000 home now worth $300,000. What are the chances of that happening? I would say slim to none. So if you're interested in second mortgage investing, give me a call, because I've got clients that I've got two types of clients, and one that I love them both, but the client I get the most real pleasure out of is my retired clients, because they're generally sitting with an asset that's paid off. They're generally receiving only a pension. So when we set them up with this type of second mortgage investing, you should see the smile on their face when they now have this supplementary income to their pension, and they're using the equity they've built up all through their life. Like I said, 604-273-2002, or on the web at www.notapennydown.com. As usual, make it a great day, and we'll talk to you soon.